Trading in a highly catalyst-heavy macro environment requires specific adjustments to risk parameters compared to standard technical conditions. To build a trading framework for the week of August 24th, we must analyze the specific market structure as it stood at the close of August 21st. This analysis provides a structural framework for educational purposes only. It is not financial advice. We start by examining the S&P 500 to evaluate the recent short-term technical weakness. This chart displays the S&P 500 on a 1-hour time frame. Looking at the right half of the price action, we can track a specific structural pattern of lower highs and lower lows. To determine if this weakness is isolated or systemic across the indices, we cross-reference this data with the Dow Jones. This chart of the Dow Jones confirms a matching bearish trajectory. Notice the sustained downward price movement and the lower high bounce on the far right, which confirms a lack of broad buyer support. Looking only at these two technical charts would suggest an immediate short-selling opportunity. That assumption is a common trap for novice traders. This bearish price action is occurring alongside a backloaded macroeconomic calendar, which introduces a new layer of complexity to the consolidation phase. To survive this specific week, a professional trader must carefully cross-reference this micro-level price action with macro-level scheduling. Let's transition into a deeper analysis of the recent price action to evaluate the true institutional commitment behind this selling. The period of institutional selling that immediately preceded our current chart position is defined as a distribution phase. Returning to the S&P 500 chart, we examine the recent price bounce to see if buyers are stepping in. Contrasting that upward movement with the volume data at the bottom, we see the volume bars steadily decreasing as the price rises. Declining volume during a price bounce indicates a lack of aggressive institutional support. They are not buying the dip. We shift our focus back to the Dow Jones to look for price action confluence across different index types. On the Dow chart, the candlestick structure identically mirrors the S&P 500's failure to reclaim its previous peaks. This confluence across both the Dow and the S&P 500 validates the theory that the entire market currently lacks directional conviction. If institutions aren't buying, does the current data indicate they are in a state of panic liquidation? While these technical signals are traditionally bearish, we have to look at sector breadth to verify if the entire market is participating in a breakdown. Market breadth is a metric used to track where capital is moving beneath the surface of the general indices. A sector heat map reveals this underlying health by showing the individual performance of stocks in a single matrix. This market heat map reveals the underlying sector health through its mixed distribution of red and green blocks. In the top left, megacaps like Nvidia, Microsoft, and Apple show neutral performance, while pockets of buying strength emerge elsewhere, like this 5% gain in Tesla. This dynamic is known as sector rotation. Capital is moving laterally between individual stocks rather than exiting the market for cash. If this were a true panic sell-off, the heat map would be universally deep red, rather than this fragmented mixed state. The mixed breadth suggests the market is balanced and waiting for a macro trigger, supporting the wait-and-see thesis. That brings us to the incoming macroeconomic pipeline, which is the primary driver behind this current market-wide hesitation. This economic calendar for the week of August 24th maps out incoming risks, showing major data releases are backloaded. The first major volatility hurdle arrives on Wednesday, with the release of the Core PCE price index and preliminary GDP data. Core PCE is a critical metric because it is the Federal Reserve's preferred gauge for assessing inflation trends. The final catalyst arrives on Friday, an event that consistently dominates institutional focus, the Jackson Hole Symposium. Federal Reserve rhetoric delivered at the Jackson Hole Symposium frequently drives market volatility as institutions reprice their monetary policy expectations. These high-impact data drops explain the flat volume and mixed sector breadth we observed on the charts. The technical consolidation is a rational pricing mechanism. Institutions are waiting for these catalysts to be released before committing to a direction. Now we transition from market analysis to actionable strategy, formulating a tactical plan based directly on the data. The baseline expectation for Monday and Tuesday is choppy, low-conviction price action. We are preparing for a range-bound market environment, with price oscillating sideways between established defensive bands. Institutional algorithms typically do not deploy heavy directional capital prior to the PCE print on Wednesday. Your tactic should reflect this. Trade with light size, scalp intraday ranges only, or stay flat. Capital preservation is the primary goal of this early week phase. Avoiding the Monday and Tuesday chop ensures you have the psychological capital and financial margin available for the high volatility breakouts. That brings us to the aggressive strategy for Wednesday and the final trading sessions of the week. We must prepare for a transition from range trading into breakout or breakdown mode. We are watching for a clear breakout trigger mechanism tied directly to the macro data release. You can use the Wednesday morning core PCE release as the initial volatility trigger to establish a new trend direction. Once in those trades, you must actively manage risk on the new positions as Friday's Jackson Hole Symposium rhetoric begins. Professionals focus on reacting to the market's response to the data, rather than trying to predict the outcome of the data itself. Professional risk management means waiting for the market to commit to a direction, which turns macro uncertainty into a structured probability matrix. In a catalyst-heavy week, objective discipline must always override emotional prediction.